Welcome to this question, the Pillay family. We'll start by reading the question and I'll point out some things to you guys. We'll have a little bit of discussion, things you should have thought about, what I would recommend that you think about, and then we'll move on to answering the question. Okay, so let's start. It says, during the 2019 year of assessment, Carl Pillay, who is 66 years old, followed the advice of his financial advisor and formed the Pillay Family Trust for the benefit of his family. Okay, so this is in the 2019 year of assessment. Okay, so for individuals trusts, remember that means the 28th of February or the 29th if it's a leap year, the last day of February. And I tell you the beneficiaries of the trust are Miriam Pillay, Sophia Pillay, and Jacob Pillay. I'll give you the different ages. Now, you'll have to assume that this 66 years old, if you read it here, maybe it's a little bit vague. It feels like, was he 66 when he was 2019? Potentially. But I understand why you would say that. But 66 years old is what we'll look at. Because unless they tell you otherwise, you should have assumed that's the current age. Right, so 66 years old, most important thing there to see is that he's older than 65. Suppose we can just do it like that. So remember what that means. It means he has a different section 10(1)(I) interest exemption. It means he has the secondary rebate. His medical aid will be different. I'm just thinking of a couple of things that come to mind. Okay, there's a couple of fringe benefits, for example, which work a little bit different than medical ones. So what I'm trying to show you there is when you see these things, I'm not saying write it down like I've done. I mean, quick enough. But just start thinking what the connections are. Then the rest of these people are all younger than 65. So and also they have different section 10(1)(I). They only have one rebate. The medical aid works a bit different. Okay, but usually I just do. We know that those things are the standard ones. So for people 65 or older, just look at the differences. So it tells you assets transferred to the trust by Carl Pillay. Remember, that's this person that created the trust. So it says on the date, the 1st of August 2018. So that's the 2019 year. Of the formation of the Pillay Family Trust, Carl Pillay transferred the following assets to the trust. See the word transferred? Is it a sale? Is it a donation? We don't know yet. We know it transferred. The ownership moved. So he either sold it or he donated it. Okay, so the first one is South African share portfolio. Carl Pillay donated part of his portfolios of shares in South African companies to the Pillay Family Trust when its market value was 2.89 million. Okay, so a couple of things you would think about there. It would obviously depend on what year you are looking at for the question, year of assessment. But in this year, the 2019 year, when this trust was created, there was donation. This donation over here was a disposal of an asset, so you would have calculated CGT on it. The 2890 was the proceeds for Carl, but that 2890 is now the base cost for the trust. So when the trust got it, that was the market value. So they were treated as if they purchased it at its market value. Remember paragraph 38 of the 8th schedule. Okay, but this is a donation. So if it's a donation, there's a couple of things that needs to pop into your mind as well. Section 7 can apply. Now, again, Section 7 is not there because there's a trust. I know this question does have a trust in it, and that's what we see it most often in questions. But remember, Section 7 applies if a person made a donation. Then that donor can be taxed. So I'm just reminding you, if a donor donates money to a trust and it goes to his daughter, or he donates an asset and it generates income, goes to his daughter, and she's a minor, we know that he gets taxed under Section 7.3. But remember, that section would apply even if he donated an asset to his daughter and the income from that asset went to the daughter. He would still be taxed because there's a donation. It doesn't have to be a trust. It has to do with donations. Go and look in section 7. You don't see the word trust anyway. Okay, then, so that was the donation. Then there's investment property, flats in Cape Town. Carl purchased 2 flats in a new development in Cape Town in 2009 at a cost of 2.9 million rands each. So that was the base cost for him when he purchased it in 2009. He purchased these properties as investments. Okay, so it's capital nature, it's not trading stock, and derived rental income from letting these flats to holidaymakers. Okay, so he had a little bit of income there. It also tells us that the flats have rental income. Carl sold these flats to the trust at their market value of 4.2 million rands each. So this was a sale, not a donation. So that means section 7 cannot apply. Now remember, if he sold it to the trust, but he did not charge interest on it, that interest is deemed to be a donation. Remember also to consider section 7C, right, for donations tax. But it's considered to be a donation. So then he could be taxed. And remember, that's where we consider things like the volage limit and so forth. Okay, but they don't tell you there's a loan. So if they don't tell you anything, you'd have to assume that the trust paid him for this, or that he got his money for it, or that it's at market value. You can't assume otherwise. The trust continued letting these out to holidaymakers. No member of the Pillay family has ever used these flats as a residence. Okay, so they're trying to tell you there's no primary residence exclusion that you'd have to consider. There's a disposal. Okay, so the trust owns the block of flats, or not the block, the 2 flats in Cape Town. It makes rental income. There's no donation. Okay, so that's things to share away. Then, information on other assets owned by the trust. So the first bit was assets owned by the trust, but which ones were transferred by Carl Pillay. And these are just now information about other assets. So it says it's a foreign shareholding. Thomas Pillay, the father of Carl Pillay, passed away in 2021. In terms of his last will and testament, he bequeathed his foreign shareholding in Watermelon PLC to the Pillay Family Trust. The Watermelon PLC is a foreign company. It's foreign shares. They tell you Carl Pillay's father donated it and he passed away. Remember, that means there's no donation. So section 7 cannot is the thing that I'm trying to say, cannot apply. Okay, the shareholding comprised 8%. 8% is less than 10%. 10% is important because if you think about section 10B2A, it tells you if you have 10% or more of the shares in a foreign company, then foreign dividends are exempt. Okay, so 8%, the market value of these shares correctly translated to South African rand was 3.9 million rands on the date of Thomas's death. So this is the base cost for the trust. Any dividends declared by Watermelon PLC are subject to a withholding tax of 12% in the USA. So here I would say section 6 quat might apply, depending on what the question asks. Remember that would apply if they ask you for tax payable. If they just ask you for taxable income, you wouldn't do section 6 quat. Okay, because taxable income is gross income, less deductions, less exempt income. Right, that gives you taxable income up to there. So if they ask you to calculate up to there, you do it up to there. If you have to go further, then you say tax for a company, for example, is at 28%. And then from this, you have to deduct the section 6 quat rebate. So that will give you tax for the year, not normal tax. So what I'm saying is, don't be so keen to put section 6 quad in. If they ask you only for taxable income, you won't even look at section 6 quad. Okay, but section 6 quad. 12% withholding tax, and also just remember always, if you remember this already, then I wouldn't even make a note in the exam. I would just say must include gross amount. And this is just to remind you that if they tell you that you received foreign dividends of £88, let's say, you should say times 100 over 88, and it will give you 100. That is the gross amount, because they tell you this withholding tax 100, that's the gross amount, less the withholding tax of 12% gives you 88. So if they give you 88, it's the amount of the withholding tax. Remember, you must always include the gross amount, always. It's gross income principle. That comes from that court case, also Witwatersrand Association of Racing Clubs case. Right, so just as a friendly reminder, and then there's a fixed deposit, local. The trust has a fixed deposit account with Absa Bank. In terms of the trust deed, any dividend income, local and foreign, which are not distributed to the beneficiaries must be invested in a fixed deposit. Okay, so we talk about the dividend income, local and foreign. Remember, there was the local ones, and here's the foreign ones. So they say all of the dividend income which is not distributed. So remember, if the trust gets 100,000 rands in dividends and they give 80,000 away to the beneficiaries, there's 20,000 left. That amount is left. They invest it in the bank and it earns interest. Okay, but they do that for both foreign and local dividends. The fixed deposit contains only amounts of undistributed dividend income and the interest earned on those funds. Okay, so they try and tell you there's no other income that goes into those that makes up that amount. Okay. Then they tell you, trust deed, a summary of the important information from the trust deed. So remember what the trust deed is. The trust deed is the thing that tells you who gets what income from the trust, who's entitled to what asset, who must get paid when, who shouldn't get paid, what's conditions. It basically tells the trust how to exist. It's almost like a little memorandum. So here we go. It says income description and trust deed requirements. So the local dividends. Remember again who the local dividends are from? From coal, Pillay. So I would even just already start thinking about things like that. Don or coal. It says Miriam Pillay has a vested right to an annuity of 100,000 to be paid from dividend income generated by the South African share portfolio. So she has a right to receive an annuity. So that means every year she must get that amount. Now remember also, I'm going to just make this comment here, it is then not exempt per section 10(1)(k). Because remember, local dividends are exempt. But if it's an annuity, it is not exempt per section 10(1)(k). And that rule is in section 10(2). Go and look at section 10(2). It tells you if you receive dividends as an annuity or foreign interest, then section 10(1)(h) and section 10(1)(k), those sections are not applicable. Make sure that you know about that, guys. If you haven't seen it yet, go and take a look. Okay, then it tells us about the rest of the local dividends, so the amounts which are not annuities. Miriam also, sorry guys, is the spouse of the donor. Now remember, when you see the spouse of the donor, you have to think about section 7, section 7.2. So section 7.2 has basically two parts to it, A and B. The one part they talk about if the two spouses are on business together, you can only get your share of the income. If you get more or less than that, this is a donation to or from a person. We'll see that a little bit later. The second one says if a spouse makes a donation and there's income from the donation, but it was done to reduce or avoid tax. That was the main consideration. Then the spouse should be taxed on it, the one who made the donation. So it's the same as section 7.3. It says if a donor gives something to a minor, then the donor's tax. This one, that says section 7.2, says if the donor gives something to the spouse, but the sole or main reason for that is to avoid tax, that's the main consideration, that's important, then the donor will be taxed. In this case, there's nothing that indicates that they're trying to avoid tax. Dividends are exempt. So it's not going to increase anyone's income tax. Okay, obviously here it's not exempt, but there's no reason, there's still nothing that indicates, if they said something like, Carl didn't want to get taxed on it because he has a higher tax bracket or something like that, sure, then that's an indication, but there must be something that indicates it to you, don't just assume it. Okay, so the local dividends. Again, the donor here is Carl. The trustees may use their discretion to distribute any dividend income from the South African share portfolio to the beneficiaries. They may use their discretion. The undistributed amounts must be invested in the fixed deposit of ABSA. 50% of the undistributed amount is vests in Sophia. It will be paid to her when she turns 21, and should she die before that age, it will be paid into her estate. Okay, quite a bit of things to unpack here. First thing is, they tell you that the trustees may use their discretion. So there's no one with a vested right. No one has the right to receive income. And what I'm referring to there is from the amounts that the trustee is distributing. They tell you the undistributed amounts must be invested in the fixed deposit of ABSA. And you'll remember here when we saw this fixed deposit, it told you this fixed deposit gets local, all of the undistributed amounts. Okay, so that's what they're referring to. Okay, so it goes there. They say 50% of the amount vests in Sophia. That's important. Of the undistributed amount, it vests in her. Now they tell you it'll be paid to her when she turns 21. So they're retaining it in the trust, but it belongs to her. And remember, the fact they tell you that if she should die before that age, it will be paid into her estate means it definitely vests in her. It's hers. Sometimes they'll write and say it'll go to her when she's 21, but if she dies before then, it goes to someone else. Then it doesn't have a vested right to it until she turns 21. Remember that, it's important. Okay, then the rental income from the flats in Cape Town. Remember the flats were the ones which Carl sold to the trust. Sophia and Jacob Pillay each have a vested right to 50% of the net rental income generated by the two flats in Cape Town. So again, Sophia and Jacob, they are the children. Sophia is a minor. Jacob is not a minor. They each have a vested right to 50% of any capital proceeds that may arise on disposal. So they say the rental income that is made, they get 50% of that each. They've got a vested right to it. And if the properties were to be sold, 50% of the amount, the money that they get from that must go to each of them. Then the foreign dividends. Foreign dividends, again, came from the grandfather, right, Thomas Pillay, in terms of his will. And it tells us, Sophia Pillay has a vested right to 20% of any foreign dividends generated by the foreign shareholding. Jacob Pillay has a vested right to 30% of the dividends generated by the foreign shareholding. So they each have a right to it. No one talks about the rest of the remaining 50%. Okay, so no one has a vested right to that. Then the local interest. Now remember, the local interest comes from dividends, both local and foreign dividends, which were not distributed. So it says Sophia has a vested right to 20% of any local interest that is earned. Sophia's vested right will increase to 25% once she turns 21 years old. Jacob has a 25% vested right to any local interest that is earned. So what vests in her? 20 or 25%? Okay, 20%, because she's not 21 years old yet. So if she never turns 21, she's never going to get it. No person has a vested right to the income that is not distributed. Okay, so then they give us the distribution table over here. So let's take a look at the headings. Local dividends, they tell you it's the gross amount, so that's before any dividends tax. That's great, that's the amount we want to use. Right, I'm going to make the comment here. At the top here, I'm going to remind you that Carl is the donor. The net rental income is from those flats in Cape Town. And I'm just going to write here, no donor. The foreign dividends, net of withholding tax. Remember, that's 12%. So you have to gross this up. The foreign dividends, there's also no donor. Then there's local interest, and this is from the local dividends. Now, because Carl is the donor of the local dividends, he basically then donated that interest. That's the interest that is generated by those local dividends. So that amount over there, or that income over there, important, Carl is the donor. And then local interest on foreign dividends, this is from the grandfather. Grandfather has passed away, so there's no donor. So only in these two columns over here, where Carl is a donor, can you apply section 7. Okay, so remember now, quick run through. Section 25B says, does anybody have a vested right? If you say yes, okay, then let's actually quickly do it like this. Was there a donation? If you say yes, section 7 considered. Okay, so we're going to ask like this. Was there donation? Yes, section 7 applies. Does it apply? Yes or no? If it yes, the donor gets taxed. We also say, section 25B, was there a donation? No. Is there someone with a vested right? If the answer is yes to that, then that beneficiary, the person with the vested right, is taxed. If you say no, then the trust is taxed. Now remember, this vested right is either one where you have a vested right but you haven't received the money, so like that one for Sophia, where she has to wait until she turns 21. But it is also the moment that the trustees use their discretion to pay an amount to you. So if you have no right to an amount but they use their discretion to pay something to you, then you also get for that specific amount of vested right, so then you'll still be taxed. Okay, so that's just a quick reminder of how that works. Quick little bit of revision. Okay, so now, only in these columns will we consider section 7. The rest of them, we'll just consider section 25B. Okay, so Miriam, I'm just going to write yes, a spouse. Sophia is a minor. Jacob, we don't know yet, but you'll remember now, I'm just going to, for the sake of it, once you've read through this whole question, you'd come back and then you would remember and see that Jacob was a resident plus a non-resident. Okay, but we'll talk about that. When we go further down, it says rental income from the flats in Cape Town. This is now further information, so they're talking about this rental income over here. Okay, they tell us the rental income was earned as followed. From the 1st of March 2022 to the 31st of November, they earned $650,000. And then for the rest of the years, so because you remember our tax year runs from the 1st of March until the end of Feb. So they just break it down to 2 periods here. Okay, we'll see if that's important. Take a look out for 30 November, 1st of December, those dates. Looks like it's important. The proceeds from the disposal of the flats were paid into the beneficiary's account on the 28th of February 2023. Now I'm going to remind you, they tell you here that these people each have a vested right to it. Okay, sorry, and then they tell you the proceeds from the disposal of the flats, which is over here, were paid into their bank accounts. Right, they tell you also here that they each have 50% vested right to proceeds from the disposal. So let's all see the disposal. They say on the 28th of February 2023, so that's the last day of the tax year, the trustees disposed of the 2 flats in Cape Town. A wealthy foreigner approached the trust with an offer to purchase the flats for $8.1 million each. As this offer far exceeded the current market value, the trustees agreed to the sale, and the proceeds were distributed as per the trustee to Sophia and Jacob. Foreign dividends. The trust became entitled to a gross amount of foreign dividends of $38,830. The net foreign dividends after withholding tax were paid to the trust on the 20th. The net foreign dividends were paid to the trust on the 20th of December 2022. The foreign withholding tax amounted to $4,660. The spot rate on the 20th of December was 14.34. The average exchange rate between South Africa and the USA was 13.96. And the rand amount reflected in the distribution table above is correct. So they say to you that this foreign dividend amount here is correct. So don't now go and try and recalculate it or do anything with it. They tell you it is correct. Okay, so they give us information here. It looks like section 6 quad information. Remember, for section 6 quad, we use the average exchange rate. For section 25D, which is the section which tells about exchange rate, if it's a non-trading trust, you can choose the average or the spot rate on average. But please go and revise that. That's actually my message here. Remember to look at section 25D if you haven't studied that in a while. Local interest. All local interest was earned evenly throughout the year of assessment. You then have further information regarding the Pillay family and the Pillay family trust. Miriam Pillay, so this is the spouse. Miriam Pillay and Carl Pillay celebrated their 23rd wedding anniversary in August 2022. They are married out of community of property. Okay, that's cool. Remember, if they were in community of property, you would have to apply section 7 to B, and that basically tells you they need to split things like interest, rental income, dividends. Okay, but be aware of it. Miriam and Carl run a small bakery through a partnership. This partnership generated a taxable income of $1.45 million for the 2023 year of assessment. Right, a taxable income, not gross income, not revenue. Look at the word, taxable income. So it means it's after deductions and allowances. Miriam has a 65% interest in the partnership, and Carl has a 35% share. Miriam and Carl agreed that Miriam would receive $1,087,500 and Carl would receive the balance. Okay, so if we say this, 1450, okay, she has a 65 interest, he has a 35. 65% of that, 35% of that is a what? $507,500. Okay. So this has to be $942,500. So she took 1,087,500 instead of 942,500, and he took 507, or he should have had 507,500, but he's only getting 362,500. So this is where section 7.2 will apply. You'll be taxed on the full 507,500. Okay, Carl Pillay. So this is the donor. Carl Pillay has chosen to invest in local shares. Okay, and remember, he also donated some local shares to the trust. He typically holds his shares for a period of 4 years or more and only disposes of shares at an earlier date if it becomes apparent that the investment is not performing well. What are they trying to tell you here? They're trying to tell you it's capital in nature because he's investing in local shares, right? Like he holds it for at least 4 years. Now again, those aren't hard. So holding it for 4 years doesn't just make it capital because it's 4 years. It's more the fact that they're trying to tell you he doesn't just buy and sell and make quick profits and losses. The information below relates to 2 investments he held during the year of assessment. Shares in Motherboard Limited. Carl purchased 5% of the equity share capital of Motherboard in 2018 at a cost of 450,000. Motherboard is a South African tech company which manufactures components that are used in smartphones. On the 1st of August 2022, the directors of Motherboard declared a distribution of 2.5 million to its shareholders, of which 500,000 has been designated as contributed tax capital. The distribution was paid on the 2nd of September. Okay, now, what does that mean again? Can you remember? It means that 2.5 million, like this, they say 500 of that was contributed tax capital. And that means that the rest of that, 2 million, must be what? Dividends. Remember, if you give something to your shareholders because they're shareholders, it's either contributed tax capital or dividend. It's the only things. Okay, so this amount over here. So this will be gross income. Let's do the dividend first. Gross income, and then it will be exempt under section 10(1)(k). Contributed tax capital. What is contributed tax capital? It's the amount that you receive for it. Now, that amount is always only treated as one of 2 things. It's either treated as sales, and that will be if you sell it, or there's a share buyback, or a liquidation. It's either that, or what it is it's an application, it's a capital amount, and you have to apply paragraph 76b. Paragraph 76b says, you take the base cost of the asset, which in this case is 450,000. You take the base cost of the asset, and from that you deduct the return of capital. Return of capital is just the capital term of contributed tax capital, because they're returning capital to you. And whatever that amount is, that gives you a new base cost. Okay, so that's what we're going to be doing with that. Then there's shares in Soul Brothers Limited. Carl purchased 100,000 shares in Soul Brothers Limited on the 1st of April 2019 from one of its shareholders at a cost of 18 per share. And on that date, they had 1 million shares in issue. So 100,000, 1 million, 10%. Soul Brothers has a June financial year end. The company manufactured rubber soles for sneakers manufactured in Southern Africa. Over the last few years, the company has come under increasing pressure due to cheap imports from China. During Soul Brothers' 2022 financial year, the directors announced that the company would cease trading and be liquidated. In preparation for the liquidation, the directors disposed of most of its assets during the 2022 financial year, and no trading took place during the 2023 year of assessment. Okay, so there's a liquidation here. In 2022, they announced it and they started selling most of the assets. This year, basically nothing has happened. No trading has taken place. No trading taking place means that there's no deductions. or allowances, right? Or you should consider at least whether they probably won't be, because it's not in the production of income. As part of the liquidation process, the liquidator provided shareholders Soul Brothers statement of financial position as of 30 June 2022. So that was at the end of the previous year. So there's property, plant and equipment, note 1, 2.6 million, cash and cash equivalents, 3.45, stated capital retained earnings, note 2, trade and other payables. Then I tell you the liquidator made a single final distribution to the shareholders on the 15th of January 2023. So it still falls within the tax year that runs from the 1st of March 2022 to the 28th of Feb 2023. And I'm just mentioning that to you because that's the tax year for Carl, and he's a shareholder here. So note 1 has to do with PPE. They tell us the schedule below provides information on how PPE balance has been calculated. Refer to further notes below. So there's a mainframe, machine X, that had a cost, accumulated depreciation, and a carry value, and that's what we see over there. Okay, that's for accounting. So mainframe computer. The liquidator disposed of the computer mainframe to an unrelated third party at its market value of $850,000. Per interpretation note, and by general rule number 7, the useful life of a computer mainframe is 5 years. Okay, so fine, that's the disposal of an asset. Machine X. On the 10th of January 2021, Soul Brothers entered into an agreement with Chip Expert PLC, a company situated in the United States, to purchase a manufacturing machine at a cost of $230,000. Okay, foreign amount. So we might have forex gains and losses here. Okay, this is in a different tax year though, so we'll have to see. They tell you what the spot rate was. They tell you the machine was shipped FOB on the 15th of Jan. On the same date, Soul Brothers entered into a forward exchange contract. The terms of the FEC would require them to purchase $200,000 on the 28th of May for a spot rate of $13.45. Remember, that's exactly what a FEC is. You buy or you sell in future. So they say here they will have to pay $13.45 rands for $1, and they have to buy $200,000. So whether the exchange rate goes up or down, doesn't matter. They know how much they're going to pay. They tell you what the spot rate was. They tell you Soul Brothers settled its account with Chip Experts on the 28th of May 2021. That's still in a prior year. That's the 2022 year if we're running from February. Or if we're looking at this company, which is a June year, tax year or year ends. And I'm talking about this company, June. So for them, it's 2021. The machine was subject to custom duties of $250. The cost of shipping machine X to Soul Brothers premises amounted to $80,000. Okay, so there's a couple of amounts here. There's customs. There's shipping. Financial accountant expensed these amounts to the same of comprehensive income. The machine was brought into use on the 18th of April 2021. Okay, so that's the 2021 year. And the liquidator disposed of this machine for 2.8 million rands. Okay, cool. Note number 2, the stated capital 3.7 million. It says the company issued 1 million shares at a value of 2 rands per share when it was incorporated in 2017. So contributed tax capital, let's start it like this, is so far 2 million. On the 14th of March, the directors of Soul Brothers announced that the company would have a capitalization issue of 1 share for every 10 shares held. The directors wished to issue a capitalization issue instead of a cash dividend, as wished to retain cash reserves of the company. On the date of the capitalization issue, the shares had a market value of 17 rands per share. So they've said 1 million divided by 10 equals 100,000. So they issued 100,000 times 17, so that's 1.7 million. That's what we're seeing there. So is that contributed tax capital, that 1.7 million? No. Why not? Because it wasn't an amount that they received. They didn't sell it or issue it and get money for it. Only the ones where you get money for it, and that's when you issue it, contributed tax capital. Yeah, they paid it out of the retained earnings, their past profits. And it's definitely not. So guys, remember, it's not a contributed tax capital. Okay, it goes into retained earnings it is a dividend basically. It wasn't a dividend at the time when it was issued, but it will be a dividend now. Okay, because it will form part of the reserves. So Sophia Pillay is the child of Carl and Miriam Pillay. She's currently in grade 11. She turned 17 on the 18th of April. So remember, this means that at the end of the tax year, 28 February 2023, she's 17, not 18. Okay, it's not that important actually. It's more important when a person is 65 or older. Then Jacob Pillay, child of Carl and Miriam. He's 23. He's not a minor. He decided to immigrate from South Africa to the Bahamas on the 1st of December 2022. Strong word there, immigrate. It means he's not just visiting, he's going. Okay, so his tax year starts on the 1st of March 2022, on the 1st of December 2022, and then we have 28 February 2023. Here, basically on the 30th of November, the day before, they tell him it's his last day, the day of immigration. So what happens here? Section 9H will apply. He goes from being a resident for tax purposes to a non-resident. So section 9H applies. It means there is a disposal of all assets except immovable property in South Africa and permanent establishment assets in South Africa. Okay, as a resident, he's taxed on his worldwide income. As a non-resident, only income from a South African source. And these are all important things to consider. Okay, so the period before immigration. Jacob and his best friend Sandra learned how to make fine leather shoes when they were in high school. Whilst they were at university, they made a handful of pairs to give to their friends and families. One day, Sandra's aunt, who lives in the Bahamas, visited her family in South Africa. She was astounded by the quality of the shoes that Sandra and Jacob made and told them that there would be a large demand for their shoes in the Bahamas. Jacob and Sandra researched this opportunity, and during 2020, Sandra moved to the Bahamas. She and Jacob formed a company called African Shoes ULC in the Bahamas. Sandra and Jacob each own 40% of the shares in African Shoes, and the remaining 20% is held by an investor who is a non-resident, and it provided them with the capital to form the company. The company is fully managed in the Bahamas. Business is taken off, and shoes from African Shoes are highly sought after, thanks in part to popular Instagram influencers who frequently feature the shoes in their posts. Companies do not pay income tax in the Bahamas. Okay, so it's a tax haven. Jacob transformed part of his garage at home into a workshop where he manufactures shoes. He then sells these shoes to African Shoes. African Shoes sells this to the public. There is a similar arrangement between Sandra and African Shoes. So African Shoes is the company, remember? So he makes it, then he sells it. He doesn't work for the company when he does it. He makes it, like he's an external person, sells it to the company, and then the company sells it. It's like trading stock. Okay, there's nothing wrong with that. There's nothing strange at that yet. It says Jacob sells the shoes to African Shoes at a price that is significantly less than its market value. Now that's not fantastic, because African Shoes is a non-resident company, plus Jacob, who owns 40% of the shares. Because he owns that, he is a connected person. Now, what happens in this case? And it's less than market value. Okay. You'd have to consider section 31. Section 31 basically talks about what happens if there's something that's near the market value and then some party pays less tax because of it? Okay, now in this case, so let's say the shoes has a market value of $1 million, right? And cost Jacob 200 to make, and he sells it for 300 because he just needs a bit of money right now to stay alive. So this is what will happen for Jacob. His gross income will be 300. His cost, trading stock, will be 200. So he'll make 100,000 taxable income, which will be taxed on. The company will go like this. They'll have sales, because they'll sell those shoes now for $1 million. Their cost was 300,000. So they make 700,000. And that 700,000 has no tax. If this was at market value, what would have happened? Right, Jacob would have gross income, so this is Jacob, of $1 million. And this cost would be 200. So he would have taxable income of 800 and be taxed on that. So you can see, he is going to get taxed on 100,000. He should have been taxed on 800,000. This is just my quick example now. It's not the amounts here. So that is why Section 31 applies. Okay, so they tell you the following information pertains to the period 1 March 2022 to 30 November 2022. Now remember, this is when he was still a resident. It says he purchased raw material for 800,000. He used all of it, so there's no closing stock. He paid two assistants 12,000 per month until the 30th of November, and he sold it to African Shoes for 1.5. The market value was 2.2. Then on the 30th of November, Jacob owned the assets shown below. This is right before immigration. All the assets were purchased in the last 3 years, all amounts shown in African rand. So the shares, personal residence, personal effect. The shares, Section 9H will tell it to be sold. Personal residence is immovable property, so Section 9H does not apply. Personal effects, Section 9H will apply, but it will be personal use. Okay, Jacob decided he would not sell the residence in South Africa. He locked up his personal effects inside the residence. He would consider letting it out in future, but for now it's vacant. Then we have the period after immigration. So this is now from 1 December 2022 to the end of the tax year, 28 February 2023. Jacob Pillay did not return to South Africa after he immigrated. Apart from the information mentioned elsewhere, the following pertains to him for 1 December to 28 February. He earned a salary of $300,000 from African Shoes. African Shoes is a foreign company. Right, so remember why I'm saying it, because the period after immigration, only South African source is an issue. Jacob manufactured shoes from his residence in the Bahamas, so it's no longer South Africa, at a cost of $80,000. He sold it for $90,000, and it's well below its market value. Okay, should we apply Section 31? Section 31 applies between a resident and a non-resident. There's no resident here anymore. Jacob received a dividend from African Shoes. There was no amount of withholding tax paid. Okay, so up to there for the Pillay family.